Welcome to the Grab the Map podcast, where we don't just look at it, we grab the map. I'm your host, John Crutchfield, and I'm so excited that you joined us today on the podcast. I like to jump right in because today we don't have a rookie for a guest. We've got Neal Bawa. Neal, thank you so much for joining us today. How are you today?
Fantastic. And thanks for having me on the podcast. I'm looking forward to it.
Hey, man, you told me you're from San Francisco, from the Bay Area. Is the weather the same every day over there?
It isn't, but let's just put it this way. I think overall, I'd say San Francisco, San Diego, and Hawaii have the best weather in the United States. And so it's nice to be one of the top three.
Yes, because over here in Dallas, where I'm at, we deal with desert conditions when the summertime hits. So it is full summer mode right now. We'd love to be in the Bay Area. So you're living the dream from what I hear, right? You are multifamily entrepreneur extraordinaire. And I was glad that we were able to get connected because we've got a lot of people that are looking to get into multifamily, also building out their real estate businesses. And it's helpful to have somebody like you, very experienced guest of experience with different market conditions and market cycles, to come on and talk to us today about investing. So why don't you just do this, because everybody's not a fan or a crush like I am. Maybe you just start with an introduction of yourself, and then we'll talk about the market and the conditions that we're in today.
I'm a technologist, computer science degree, data science is my major. I've had a successful tech career. I've run a company for 15 years, had a successful tech exit, got into real estate simply because I had the big fat tech salary and I live in California. So I was paying 50% of my salary to the man. And I decided I didn't want to do that anymore. So I got into real estate basically for tax reasons in 2003.
Yeah.
And for the first decade, basically, it was just me either buying single family homes for myself and my family or building campuses for my technology company. And then 2013 is when my company was sold. I had a massive exit and had an absolutely enormous mountain-sized tax bill. And I learned then that if I was a limited partner in multifamily, I could get depreciation. But if I was a general partner, I could get a lot more depreciation. That started my journey as a syndicator. So it's been about a decade. It's been a lot of fun, a lot of stress. About 1,000 data-driven, geeky, nerdy investors are currently invested. More than $300 million of their money is invested in our deals. The portfolio used to be $1 billion in value, Johnson, but now we think it's worth only 700 million. Why? Because we've sold a bunch of things and we've also you have to mark down the value of these things, and because multifamily values have fallen a lot, which I think is pretty awesome for new investors going in because they're obviously buying everything in America right now that's multifamily is a discount.
Yeah, only 700 million. That's a thought, right? Only 700 million. I think there's a lot of people that are listening to this like, well, if I only had $700 million in assets under control, that would be a great problem. So you've got a great, great problem. I heard a couple of things in your introduction that I just want to highlight. Number one, you saw the problem that many of us face when working W-2, where half of your income is going to somebody and you don't have control of it. So instead of whining about it, you decided to jump out there and start working for yourself. You're highly successful for yourself, and then you realize the government tries to get their hands on it again.
Yeah, it really started with a bunch of people in the Bay Area. I haven't worked for one of these super fancy companies, and I don't want to because these friends of mine, they work for Apple and Google and they work 14-hour days. So I think that the goal was not just for me to fix it for myself, but also to fix it for other people. And they've managed to substantially reduce their taxation, which has been perfect because over the last 10 years, California has become more and more aggressive on taxation, just charging more and more in all kinds of hidden taxes. One of the rules in life for any new investors is stop thinking about what you make. It is not relevant. Only think about what you keep.
Yeah.
Every investor must at all times in their mind know what percentage of the money that they're making they're keeping. In other words, when you file your taxes, on the first page, there is a summary. At all times, you must know the number there that says, what was your tax percentage? For example, if your tax percentage was 21.4% in taxes, combined California federal or state federal, then what you keep is 78.6% of your income. So let's say you make $100,000, you're keeping 78,600. The only number that you should ever have in your head is I make 78,600. You should always be thinking, how can I make a higher percentage than 78.6, right? Your gross income is only there to stroke your ego. It's not there for you to build your life.
Absolutely. Absolutely. I love it. I love it. Know how much you're being taxed and know what you're really making. I think that's a good takeaway. There's a lot of people that are new though, and they're trying to navigate a market that has changed over the last several years. They may hear things like interest rates are higher, or maybe there's not as much product hitting the market, maybe inventory is low, and they're trying to figure out an opportunity, how to get involved, right? What would you tell a new investor that's trying to get started today about how to get involved in the market like today?
First, I'd like to start off by saying you have the easiest freaking job in the world, and I'll explain why. What I'm going to do is I'm going to contrast the market as it was 27 months ago, and I'm going to contrast it with the market today. And we'll talk about the good and the bad of these two markets, because the market has completely changed dramatically, basically has flipped in the last 27 months. In multifamily, we use a measure called cap rate to figure out how much we should pay for a property. And then cap rates are inversely proportional to price. What that means is, as the cap rate goes down, the price goes up. So if you pay a much lower cap rate, you'll pay a much higher price. The prices peaked for multifamily, which is the largest asset class, by the way, in commercial real estate. The only asset class in real estate that's bigger than multifamily is single family, and you can't really monetize that easily. And multifamily prices peaked in March 2022, which is 27, 28 months ago now. So 28 months ago, the market was at its peak. And 28 months ago, ironically, was very easy to raise money. Incredibly easy. Investors were throwing money at it. And they were doing the exact opposite of what they should be doing. Everybody was throwing money, but because the market just kept going up and up, and nobody was asking the one inevitable question: if the market keeps going up and up, aren't we buying more and more expensive buildings? Aren't we getting less and less for our money? Nobody was asking that. I was screaming about this on podcasts. Nobody was listening. Everyone was just buying buildings left and right.
Yep.
And back then, everyone was like, yeah, I can't lose. The prices are all going up. It's such a nonsensical idea that they will keep going up. Eventually, as interest rates started to go up, first, multifamily prices plateaued. Then they started to decrease slowly. And then in the last year, they started to decrease fast. Why? Because multifamily is a business. And banks have said, your mortgage has doubled. I'm not going to give you the same loan amount. I'm going to give you a much lower loan amount to protect myself. They're actually also protecting me, because I might take on too much risk and pay too much for a property. And what they're saying is, no, if this property was worth $30 million before, now with mortgages being up, this property is only worth 22 million. So we're going to give you a much smaller loan. And prices, I didn't have to go and drop the price. I didn't have to negotiate. Prices automatically dropped because the amount of money that the bank was willing to give you on that particular property kept going down for the last 28 months. And so today, right, a property that was worth $30 million in March 2022 is worth roughly $23 million now. But this property's income has not changed.
Right.
Its income is the same. Why? Because in the last 2 years, we haven't seen a lot of rent growth in the US. Why? Because rent growth was insanely crazy in 2021, as much as 15% for the US, with the long-term average being about 2.5 to 3%. There had to be a cool down effect. So we've been in that cool down. Rents haven't really dropped much in the US, but they've been flat. And so as a result, the income for this property is the same, John, but its price is $7 million less in my example.
Yeah.
And so it's an incredible time to be buying it, because you're like, I'm getting the same income. And so the question is, why would not everybody just jump in and buy? The answer is because interest rates are high. So your cash flow is still struggling just as much as it was 27 months ago. 27 months ago, you were paying a lot, so your cash flow was struggling, but rates were down, right? Today, you're paying a lot less, but rates are up. So your cash flow is still down. But this is the ideal kind of scenario for me because the price never changes, but interest rates go up and interest rates go down. Now, when interest rates are low, investors foolishly believe that they will never go up, which is why in 2022, no matter how big a building you were buying, investors would give you the money immediately, right? Not even
Right.
questioning the fact that you were buying something that was very expensive. Today, the same investors don't want to give you money, even though you're buying it 25% cheaper. Why? Because their new belief is interest rates won't go down. Neither of those two beliefs is rational. Interest rates do go up and interest rates do go down. Inflation rises, inflation falls. The best way to understand what is the happy medium is to look at both rents and inflation since World War II. The charts are available on the web. They're also available on the St. Louis Fed's website. And when you look at those charts, one thing is obvious. The United States, as a developed economy, actually suffers from low inflation. And most of the time, the Fed is trying to juice inflation. They're trying to increase inflation. Why? Because if you look at the last 12 years, with the exception of the last 24 months, inflation's been too low. The Fed's goal
Right.
is 2%. If you average out before COVID started, what inflation was, I think the average was like 1.3%, right? So the Fed's job most of the time is how do we get inflation up to 2%? Because we can't keep paying back the federal deficit if inflation is not at 2%. But every once in a while, a politician does something stupid. In this case, our politicians did something incredibly stupid after COVID, in that they basically printed $7 trillion and handed it to people so that they could spend it. Should some of this money have been printed? Absolutely. Should all of it have been printed? Absolutely not. The amount that was higher, the bad part, caused an inflationary spiral. And we've been suffering on it. And that's why interest rates are high. Now, obviously, everything's addressing, right? So the Fed raised rates to ridiculous levels. And because of those ridiculous levels, the US economy is starting to slow, manufacturing is contracting, and inflation has come from 9.2% at its peak, which was last year in June, all the way down to 2.7% in at the end of May 2024. So its path is from 9.2 to 2.7. It's a downward path. And remember this, economists know this. Inflation doesn't come down in a straight line. It comes down and then it starts to plateau. The last 1% to get inflation from 3 to 2 takes the longest and is the hardest. That's where we're at right now. But so far, the Fed's been successful. And so we know that going forward at some point of time, and I don't know what that point of time is, interest rates will be lower. They may be lower 1 year from now, or it might take 2 years. It might even take 3 years. Unlikely, but it might take 3 years. The point is this: once you get the discount today for a property that you buy, rates can change, but the discount's locked in.
Yeah.
So to
The
me,
price.
I'm very greedy right now. I want to buy everything in the market that makes sense, obviously, mathematically makes sense. And my challenge is that all the whining that I was doing 2.5 years ago about price is too high, I'm not doing any of those whining right now. Prices are very reasonable. My problem is I can't convince investors. So I want to buy 8 properties a year, but I'm buying 3 because investors think this is a bad time to buy. These are the same investors that thought 2022, when prices were outrageously high, was a good time to buy. So the truth is, you're a new investor. Understand that the investing world is not real. Most investors are speculators and they follow the market. If you want to learn, don't follow the market. If you want to learn, understand that when things are cheap, it's generally a good time to buy. Understand that Warren Buffett was right. Be greedy when others are fearful. Be fearful when others are greedy. I was fearful in 2022. I am greedy in 2024.
I love it. So the strategy is to think about the appreciation that's going to happen when rates start to come down,
Yes,
right?
we currently have cap rate arbitrage. So what
Yeah.
that means is you could buy a property. Most of the properties that we're looking to buy right now are around 6 cap, okay, 6-ish cap, right? In this same property was 4 cap in 2022. Now, are we going to go back to 4 cap? I hope not, because that was a crazy time and I don't like crazy times. I like normal times. So what is likely to happen is today we're at 6 cap up here, right, which is a low price. and we were at 4 cap. What likely to happen is that when rates adjust, we might go from 6 cap to 5 cap over 2 years or 3 years. And what most investors don't understand is on a $30 million building, a change of 1 cap in your favor completes your business plan, even if you don't rehab a single unit.
Yep. Yep.
If you do nothing and the cap rate in the market changes by 1 cap, you've met your business plan. And this is very rare to have a 1 cap arbitrage ever.
Don't wait to buy real estate, right? Buy real estate and wait. And
Yeah.
I think that's exactly where we are right now. So pretty cool. What I think you're talking about is a bit of distress in the market, right?
Mm-hmm. Yeah.
And I know that's something that you like to talk about. So talk to me about the distress that we're seeing right now.
Right. I'm going to start out by defining the word distress. Yeah, last week we made offers on 2 properties, or last month, and we didn't get any of those 2 properties. You know why? Because there was too much competition. Too much competition, right? There were 13 offers. We barely squeaked into best and final, and then we lost each property by about 200, 300,000. The difference is we were still losing those properties, but we were losing them by $2 million 2 years ago. Now we're losing them by 200,000, but we're still losing, right? So there were 30 people trying to buy this property. And there's people who think multifamily is in distress. It is the dumbest idea that I've ever heard. There is no distress in a market when 13 people are trying to kill each other, trying to buy a property with $200,000 hard on day one. If you think that's distress, perhaps you should go back and check the definition of the word distress. The market has no distress. What is distress is that there's a portion of the market. So overall, there's over 100,000 apartment communities in the United States. 2,500 of them have their interest rates resetting this year. Either their rate cap is expiring or the bank says, I only gave you a 3-year loan, now you got to sell your property. Those 25% represent less than 2.5% of the United States stock. And in the coming 12 months, those properties have to be sold. And they have to be sold, most of them, at a loss.
Yeah.
In most of them, the investors will either lose money or lose all of their money. But here's the cool thing. The banks are not worried about it because the value of the properties today is still higher than the loan amount. And that's all the bank cares about. They don't mind that all the investor equity got wiped out. So what is distressed in the United States is 2.5% of the multifamily market. These 2,500 properties have roughly, I would say, 75,000 investors.
Okay.
And those investors' money is distressed. The market has no distress. There are no sales happening of multifamily on the steps of the courthouse. There's no bank willing to give you even 10% discount on a property that has been returned. There's no bank willing to give you 5%.
Yeah.
Banks are simply like, sure, you can't extend your, I'm not going to extend your loan, pay it back to me, right? Pay it back to me, give it back to me, and I'm just going to give it to a broker, and in 90 days, there'll be 10 offers on it. Somebody will buy it, and my money will be returned because there's no distress in the marketplace. So investors are distressed. Syndicators are distressed. The market has no distress whatsoever. Please share one market in the United States that actually has multifamily properties being sold on the steps of the courthouse. Please, I'll give you $50.
Yeah, it's not happening. It's not happening. When you're approaching offers right now or approaching sellers, do you have this operator or syndicator distress in mind?
We do, but for the most part, I have to say this. People are like, oh, there's distress in the market, blood in the streets, and all kinds of stuff will happen. No, the only thing I'm getting out of it is that I'm paying 25% less for the same property with the same income. That's my benefit, 25%. If I'm looking for something magical, where I'm going to hire this person, he's going to call all these distressed people, and we're going to do all these off-market deals and get 35 to 40% off. That's just lies for podcasts. In the real world, none of those things are happening because there's no distress, right? So let me give you an example. This year, roughly $78 billion of loans in the office sector were coming due. Out of those 78 billion, $48 billion have been deferred by the banks to the future,
Yeah.
meaning extended, kick the can down the road.
Yep.
But out of the $123 million that are supposed to be coming due for multifamily, only 2 billion have been deferred. Banks are not afraid. Banks are like, you want to return your property? Fine. I'm not going to extend your loan. I'll sell it in 30 days and you're going to pay for all of my selling costs anyway, right? So there's this belief in the marketplace that somehow we will get some amazing deals. Yes, by simply paying 25% less. That's amazing. When's the last time you got a 25% discount on the most privileged asset class in America?
With steady income and rising income in some cases as you
Yeah,
operate it better, right?
absolutely. To me, this is not a sexy business. Don't try to make it sexy. Don't try to make it sexy in your head, but it's a reliable business. And to me, reliability is sexy. The most unsexy things in life are actually the sexiest.
I like it. I like it. I should try saying that to my wife. Hey, look, here,
That may or may not work well for you.
it
So
may or may not work. So one of the things that I always appreciate when I hear you on other podcasts or hear you sharing is how in depth you are in your knowledge of the market and what's going on. Where does that come from? Like, how do you get that information? Is this something you spend a lot of time on?
I think it comes from passion. We live in a world where the problem isn't that there's not enough information. The problem is that there is too much,
Yeah.
right? So there are literally dozens and dozens of completely free sources of high quality information available to me. For example, ChatGPT. I'm a ChatGPT addict, right? Which
Okay.
means I use it 10 to 15 times a day, right?
Oh,
Minimum for my work. And I also use it 10 to 15 times a day for my home. For example, this morning, a ChatGPT gave me the only two fridges in America that are 24 inches wide for my garage. So I'm constantly
okay.
asking ChatGPT questions. And one of the questions that anyone can ask ChatGPT is, please name the top 10 multifamily brokers in the United States. Okay. And it'll give you a very nice list. Then say, please give me the websites of these broker companies. It'll give you a list of 10. Click 10 times, go to their website, find their newsletter, sign up.
Yeah.
Now you're receiving an astonishing amount of high quality information with charts, graphs, numbers, trends, and invitation to webinars with more charts, graphs, trends for free. You never have to pay anything for this, right?
Yeah.
So the information actually is too much, not too little. So people are like, where do I get information? Top 10 brokerages in the United States. That's all you have to do. Walker Dunlop, Marcus and Millichap, CBRE. They're providing astonishingly high quality information. They're all killing each other to give you gorgeous, beautiful charts, graphs, and insights and bringing on amazing guests. Information is out there. Your job is to distill it down to insight. Information is not the same as insight. So what you have to train yourself is A, where do I get the information? I just told you, you'd never have to get more information about multifamily again. Just follow the process that I just gave you and you'll have too much information. But then you really have to think about it and say, what is my insight from this? What is this person really trying to say? What are they trying to imply? And sometimes you have to read the tea leaves and you get better at it the more you watch. I make sure I watch at least one webinar from one of these trusted information sources, at least per week. One webinar, that's about an hour. And then I get maybe 6 to 8 emails from them every week. And I read these emails and I use a Mac. So I have a notes box. I'm one of those people that on a Mac, I don't use overlapping windows. I actually have a very large 50-inch screen in front of me and I have fixed boxes. And one of those boxes is notes. And every time I read a document, right? Every time I need a document, I only have one task. And it's a very simple task. What is the one insight that this newsletter gives me? The newsletter might talk about Phoenix. It might talk about there's a lot of incoming supply, rent growth is negative, blah, 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 blah. But none of that is the insight. You know what the insight is? Phoenix is a very powerful metro. It has a huge amount of growth. Don't buy a property there now, but by the end of the year, the supply will end. And so if you time it and buy a property at the end of the year. Next year, you get all of the rent growth, but you still get this year's deflated prices. That's my insight. I type it into notes and I forget about it. And then once in 2 weeks, I sit down with my acquisitions team and I go over all the insights that I've learned and I give it to them. Now my acquisitions team is empowered because I'm not buying properties, they are.
Yeah,
Simple?
I think it's really simple. People are always looking for ways to use ChatGPT. So you gave very practical examples for how to use it, right? And then not just how to use it, but how you digest the information and synthesize it and put it somewhere where you can remember what your insight was. I think that's amazing. And it comes across like you're really smart, and you are. So that's what we're seeing. I think another thing that comes to mind for me as you're investing, I know you mentioned you've went from maybe 8 per year to 3 per year. Has your criteria changed as the market has, I don't want to call it distressed, but as prices have contracted, has your criteria changed or what you're willing to buy?
Yes. I have a new set of 23 criteria, which are factored in, which basically are weighted in lots of different ways in an Excel spreadsheet that has 3 million columns. And everything I just said was completely made up. My criteria has only changed in one way.
Okay.
One way. And that one way is that I want to try and buy buildings with assumable loans. Because
Okay.
given that there is zero distress in the multifamily market, which I just proved to you, right?
Yep.
Given that, the only reason that a 25% discount exists is that interest rates are high. So if I can assume a loan at 4%, I get the discount without having to pay for the reason for that discount.
Oh yeah.
I get low interest rates and low price. So I have just a single criteria. And so you've learned my secret right now.
Hey.
My acquisition team gets $10,000 every time I close on a property as a bonus.
Okay.
As of 9 months ago, we no longer offer them the $10,000 bonus if they don't find an assumable loan.
You want an assumable
Right?
loan?
Until I changed this, they had trouble finding properties with assumable loans. Magically and interestingly, they now have a lot more of them because they want $10,000.
Yeah, of course they do. They want $10,000, and I love the idea that not only are you getting the price discount, but you're getting the price discount without the reason for the price discount. So I love the
That's
strategy.
my entire strategy.
Yeah, I think it's beautiful. I know I've gotten value from this. Talk to me a little bit about just what is real estate doing for your life? What has this business done for your life? Think back, you started off with seeing others work the 14-hour days and seeing the lifestyle of that high tech world over there in the Bay Area. What does life look like today for you with $700 million in assets? And I think you said you're helping 1,000 investors?
I have 1,016 investors as of
Yeah.
yesterday. So from 2018 to 2022, I met my goal, which was that I started with working about 55-hour weeks, which is 11 hours a day. And each year I reduced my work by 5 hours. I'm very calendar driven, so it's easy for me to measure the number of hours I'm working. And down from 55 to 50, 45, 40, then 35. But I've been stuck at 35 for the last 2 years because market conditions are challenging. So what real estate has meant for me is I make more dollars every year, with the exception of the last 2 years, simply because I'm waiting to sell my buildings when they become more expensive again.
Yeah.
But that'll happen. So that it's still adding up for these 2 years. And each year, I'm able to reduce the number of hours that I work. I am not passionate about working more than anyone else. That is not tied to my ego. I'm passionate about getting more done than anybody else. So I use ChatGPT more than 10 times a day to write what I call specs or project specs, where I talk for 5 to 10 minutes. ChatGPT writes an extremely detailed spec. I do not send this spec to my managers. I send it to my project manager, whose name is Afzal. He's Pakistani. He takes that, puts it into Asana, breaks it down into dozens of tasks, then calls a kickoff meeting. There, I spend 15 minutes explaining my ideas to the right people, to the relevant people. And then AFSEL makes sure that they actually do their job. This way, after 15 minutes of thinking, 10 minutes of talking with ChatGPT, and 10 minutes in a kickoff meeting, I fully explained what I want done and how I want it done. Now I can just walk away and walk in my backyard or spend time in Asia. So I spend 2 months a year traveling on vacation.
Yeah, because you're leveraging a team to help you. And geez, you talked to me about that team before we jumped on here. Can you tell us a little bit about what that looks like?
50% of our employees are always in the Philippines. We have 44 people, 22 in the Philippines, 22 in the United States. There are some things that can have to be done in the US and some in the Philippines. Would we raise that number beyond 50% in the Philippines? No, I think 50% seems optimal. We have about 200 people working on building or managing our projects. We don't count them as employees because technically they belong to the individual LLCs that we invest in. So it's a nice team, 44 people. They're very competent. They know what they're doing. Everyone's data driven. Everyone's using Slack and Asana. One thing I'd like to quote is we have 81,000 tasks in our Asana, our project management software. 76,000 have been completed. There are 5,000 incomplete tasks.
Yeah, staying busy. That's great. I know that every time I hear you and every time I get to get your insights, that I want to figure out how to learn more from you, how to hear you more, figure out where I can find you. So can you
Sure.
talk to me about people, how they find you, how they get exposed to you, how they can learn more from you?
It's really simple. First, I am the only Neal Bawa on the World Wide Web. Typing my name into Google results in about 10,000 links. Hundreds of them are videos, and thousands of them are articles. Feel free to click on any of them. If you hear bad stuff, it's unfortunately about me. If it's good stuff, it's fortunately about me. Either way, there's no other Neal Bawa out there, so that one's really easy. If you want to be more structured to take a look at our content, the best way to do that is to go to a website. It's called multifamilyu.com. So multifamily followed by the letter u.com. And there we publish our 12 webinars. Each year we do 12 bespoke, high quality, beautifully designed webinars on things that catch our attention. Obviously, half a dozen are probably real estate, but we publish webinars on things that have nothing to do with real estate, like climate change, artificial intelligence, or banking crises. These are just fun things. We know about them, so we make webinars about them. So join those, a dozen webinars a year. And in those webinars, we take 60 seconds, no more, to talk about our latest projects. So if you're an accredited investor, you can join those. If not, you can just continue consuming the content. There will never be any fee, subscription, or upsell to multifamilyu.com. It is meant to be like Wikipedia, so all of the content will be there forever for free.
Yeah, tons of value add there, tons of value you're putting out in the world. So glad you stopped by today to talk to me, and you've blessed my business for sure. Anything else you want folks out there to know? Any message that we didn't communicate today? I know I've taken a bunch of your time, but I know it's been valuable to folks listening.
I'll finish off with my two mantras and my one saying. My two mantras are data beats gut feel by a million miles, and you can only manage what you can measure. Those are my two mantras. And my one saying is this: the Bible got it wrong by one letter, because it is not the meek that shall inherit the earth. It is the geek. It is the geek.
Very
Yeah.
good. Thanks again, Neal, for jumping on today. Thanks to all of you that are listening. Don't forget that you can always comment below or leave a review. It helps this just spread a little bit further. Y'all also know that you can reach me directly everywhere at Grab the Map. Don't just look at it, folks. Grab the map.